I think we'll have most countries done by July 9th, yeah. Either a letter or a deal.
But they go into effect on August 1st. Tariffs go into effect August 1st, but the president is setting the rates and the deals right now.
President Trump striking a tough stance, saying the choice is between a deal or tariffs. But Commerce Secretary Lutnick says the higher rates won't kick in until August. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Trump now adding more pain to the trade tensions, threatening an additional 10% tariff on any country aligning itself with what he calls the anti-American policies of BRICS. Caution in the markets as investors await the outcomes of trade negotiations. Central banks in focus too, with decisions this week in several major economies. Lombard Odier CIO John Woods breaks down why he thinks Asia could still grind higher this year despite the trade and geopolitical tensions. And we'll look at how Jane Street's cash machine came to an abrupt halt in India and the ramifications for other global players. It's crunch time for major U.S. trading partners as we race towards the Wednesday deal deadline set by President Trump. The president posting on social media in the past hour that the U.S. will start delivering letters and announcing trade deals at 12 p.m. New York time Monday. He's also threatening to impose a further 10% tariff on any country that aligned themselves with the BRICS nations, which began their summit in Brazil by condemning the U.S. and Israeli attacks on Iran. But the U.S. is sending signals there's still wiggle room for more talks. Treasury Secretary Scott Bessent indicating on the weekend that the letters Trump is set to send trading partners this week are not the final word on tariff rates. That's because the levies won't kick in until August 1st, so there's still time to bring offers to the table. Now let's get more details now on trade negotiations with Asian nations. Our Chief North Asia correspondent Stephen Angle joins us in Hong Kong. Steve, talk about trade angst, right? That Vietnam deal stoking concerns in Asia, including among key U.S. allies. Japan, steadfast in saying it will defend its interests. South Korea seeking a deadline extension and wants to avoid sweeping tariffs.
I think you're just indicating in that question just how much time do we have to go through all of this, because there are so many nations that are trying to get some FaceTime or at least phone time with the White House over this holiday weekend in the United States to try and mitigate the return, obviously, the threatened return of those reciprocal tariffs of April 2nd. Southeast Asian nations like Cambodia, which were initially slapped with a 49% tariff, Thailand 36%, Indonesia above 30%, Japan 24, South Korea 25. So they have a lot at stake. In addition, you have like South Korea and Japan, and to a lesser degree India, have those added tariffs on sectoral tariffs of 50% on aluminum and steel, 25% on automobiles. So a lot is obviously at stake. And then you also mentioned at the top of the show, Haslinda, the BRICS nations condemning the unilateral approach to trade deals, and also, of course, the war in the Middle East with Israel and American strikes on Iran, and that causing a reciprocal threat from Donald Trump of an additional 10% for any nation that aligns with these so-called anti-American policies of the BRICS, who are meeting in Brazil right now. So there's so much to go through, but right now, yes, letters are going to be going out about midnight tonight, Hong Kong time, midday in the East Coast of the United States. The initial indication is it's going to be 12 to 15 letters. Scott Bessent, the Commerce Secretary, is talking about in earnest. They're having negotiations right now with 18 or thereabouts major trading partners. But there is that, maybe you could say those letters will go out with a little sprig of an olive leaf in that envelope, because it looks as though if nations are indicating to the White House that they're negotiating in good faith, they could have an extension, perhaps 3 weeks. So we could kind of say the goalposts have moved a little bit, a new soft deadline of August 1st instead of this Wednesday.
I would like to see that letter, Steve. What do we know about trade negotiations with the likes of India, Thailand? We know that Thailand, for instance, reworking trade proposals, a lot at stake for this particular country. It faces 36% tariffs.
Yeah, that's right. So I think a lot of these nations who are not necessarily at the forefront of the radar on Washington are trying to get across the goal line. I'm mixing metaphors, but you know what I mean. So Cambodia already is saying that they have a deal or an agreement, a framework deal in place. Obviously, Cambodia is a big textile and footwear exporter to the United States. So we don't have the details yet, so we'll have to see whether we get that. We're also hearing Indonesia signaled its confidence that they're close to a solid trade deal with the United States, spanning critical minerals, energy, defense cooperation, market access. And then, of course, Thailand, despite its government chaos right now, saying it's making a last-ditch effort to avoid those tariffs of upwards of 36%. Maybe we're going to have some more market access for U.S. firms, industrial goods, and more purchases of U.S. energy, perhaps even Boeing jets. I already mentioned Japan and South Korea. They're trying to get extensions, but Japan is kind of doubling down a little bit as well. Ishiba, the prime minister, is saying Japan is prepared for all possible tariff scenarios and that they're going to stand firm on some issues and defend its interests. The EU, I don't have enough time to talk about the EU right now.
Too many countries. Steve, thank you so much for that. Our Chief North Asia correspondent, Stephen Angle there. Well, our next guest believes the U.S. may opt for bilateral deals that prevent more mutual hardship in the end. Let's get perspective. John Wood, CIO of Lombard ODA Asia. John, I mean, too many countries, too many letters that we're waiting for. The fact remains, Trump has indicated he could impose as high as 70% tariffs. That could be much higher than we anticipated initially. It could be worse than most people anticipated in the end.
Hi, Haslinda. Well, just to say, I think we in the market all take President Trump extremely seriously, but as they say, not too literally, particularly his somewhat flexible deadlines. And I think the market is looking through these deadlines and the potential, as we just heard from Steve, for trade deals reasonably serious. Certainly major equity markets are making all-time highs as we speak. So yes, there's some volatility around the actual deadline event, but there is also the expectation they will be extended, and I suspect they will. I think the phrase that makes the most sense is agreement in principle, and certainly with the large 10 to 12 trading partners that the US is dealing with currently, that's more than likely. We all know trade deals are phenomenally complex to negotiate and agree upon. And to that extent, you know, a couple of weeks, 2 or 3 weeks to close these deals is really challenging. So my expectation is we will get further indications of agreements in principle, and in the months and maybe even quarters ahead, we'll get these deals finally inked and agreed upon.
The thing, John, how do you assess the damage at this point in time? If you take Vietnam as an example, 20% tariffs, that's still very high and is still damaging to its economy.
Well, the Vietnamese template is, of course, the model that much of Asia will be seeking to avoid. The UK template, conversely, will be the bilateral deal that indeed they will be seeking to replicate. I think Vietnam is peculiarly exposed due to the quantum of transshipment through that country. To an extent, Thailand, Malaysia are the same as well. So I think Vietnam could be seen as a warning, actually, as a line in the sand. Many Asian nations now will be wanting to avoid that template and may well be more open to negotiation, to less determined to double down on their positions with that risk at the back of their heads.
When we take a look at Trump tariffs during his first administration, it was targeted mainly at China. This time around, it's a bit more global. Does that create more opportunities for you? How are you looking at that?
Well, like global equity markets, we are essentially looking through those tariff risks and focusing more on underlying growth. I mean, our base case for the United States and the global economy in general is for slowing growth, but not recession. And from that, we draw the major aspects of our asset allocation. We are overweight emerging market risk, for example. We're overweight developed market risk, investment-grade credit, and neutral on the dollar. Those are our three main planks. And from that, we build our broader asset allocation by sector and by asset class. But overall, our underlying view is reasonably optimistic that we will see a deceleration in growth, but no recession. And we still anticipate the Fed will cut 2 or 3 times over the course of this year.
Can Asian markets in general outperform the rest of the region given, China's willingness perhaps to implement more stimulus?
Well, I mean, we're reasonably optimistic, not majorly optimistic on Asian risk. I think central banks have the luxury of tilting towards a dovish stance. We see growth generally improving. We see the weak dollar certainly helping capital inflows. And the earnings picture looks reasonably positive as well. So actually, I think the building blocks are falling in place for a reasonably constructive outlook. In our mind, there is no major buy catalyst which will power and push markets to all-time highs. That depends on liquidity. If we get to the point where the dollar really does weaken, then I think capital flows could have a materially positive effect. But right now, our neutral dollar stance suggests that we see consolidation given this very sharp decline, this 11 to 12% decline over the course of this year. And I suspect that the dollar is likely to be range-bound for the time. So I think it's a reasonably optimistic outlook for Asia based on those catalysts I mentioned.
When you take a look at the U.S. market, John, we know that tech has been an outperformer. In fact, those stocks are up 40% since the lows that we saw in April. But when you take a look at the different sectors, most sectors have underperformed compared to, outperforming. How are you assessing the outlook for the rest of the year?
Actually, we have a reasonably narrow focus, a reasonably narrow high conviction call on sector exposure in the United States, limited communications companies and the materials sector. Both to an extent are somewhat insulated, in our view, from the tariff risk. We see underlying consumption as supporting both. And of course, the valuations and earnings are supportive as well. Beyond that, we just see too many risks for a convincing HICO call. And as I say, that materials and comms remain our preferred exposure.
Now, when it comes to the USD, expectations are that it will continue to grind lower from here. Will that be a headache for Asian markets dealing with inflows? And which ones in particular are you looking out for?
Well, actually, a weaker dollar tends to be positive for capital inflows into Asia, and Asian equity markets in particular. And if history is a guide, the weaker the dollar becomes, typically the more supportive and constructive the backdrop for Asian equities is likely to be. So we look at these, what we call equity economies. This is where capital flows tend to be directed more into equity markets than perhaps fixed income markets. Thailand is a good example of that. And we would anticipate that, frankly, lowish levels of valuations, they're at the lower level of a 10-year average right now, would begin to look at reasonably attractive to investors. And again, if we were to see further dollar weakness, which we don't anticipate over the near term, actually it begins to look a little more constructive for the regional risk markets.
What does it then mean for gold, John?
Well, I've been looking at this and thinking about this a lot. I'm just wondering whether we saw the peak gold price a month or so ago. I think as bond yields tick a little lower, given their elevated levels. As we see that slowdown scenario manifest rather than anything close to recession, our view is that the gold will tick a little lower. We are actually underweight gold right now at Lombard Odier. We locked in profit given this extraordinary rally and have been seeking to identify more attractive alternative opportunities. But as I say, the building blocks for a constructive gold position have diminished somewhat just in the last month or so. And I think the price is tilted for depreciation in the weeks and months ahead.
John, hang tight. Lombard Odier Asia CIO John Woods is sticking around. Still ahead, oil tumbling as OPEC Plus surprises markets with a bigger than expected boost to production. A closer look at energy markets when we return. Keep it here with us. This is Bloomberg. Welcome back. Here's how benchmark Brent and WTI crude are trading after OPEC Plus announced it will boost production by more than 500,000 barrels per day in August, well ahead of expectations. This puts the group on track to unwind its most recent output cuts a year earlier than planned. Take a look where we are trading right now. Brent crude 67.78 down about 0.8 to 1%. New York crude also in the negative, down about 1.5%. Still with us, John Wood, CIO of Lombard Odier Asia. John, your take on where crude is headed from here? I mean, some say perhaps you could see oil hovering at about 40.
Well, I think that sort of news is probably welcomed by every central bank in the world except perhaps Russia, and probably there's a geopolitical dimension to that around its conflict with Ukraine. But absolutely, the direction of travel for particularly OECD countries from a growth perspective is lower. That suggests reduced demand on the price of oil. It's an unmitigated, unambiguous positive, I think, for developed and developing markets. It also rewards the pro-risk allocations that were tested during the initial conflict in the Middle East and following the US's involvement, of course, when we saw oil spike up towards the sort of the 75 area and change. We've had a very sharp decline since then. I guess markets are looking through current levels of tension and anticipating some degree of stability, if not peace, in that part of the world. And I think oil is now aligning more with fundamentals than any geopolitical premium that might have been built in over the last month or so.
The thing is, how realistic is it to think that oil might stay at surprise levels when a country like Saudi Arabia needs oil at $90 a barrel to cover its government spending?
Well, I mean, it's yes, there's a supply dynamic. I completely agree with that. But there's also a demand side as well. And as I say, with the growth outlook for developed and developing markets all ticking lower, it's hard to see where that demand is going to start accelerating materially. The only way, therefore, that price can be influenced and manipulated is more through supply. But as we saw in the recent announcement, there are clearly motivations on behalf of the Saudis to boost supply. And obviously that's putting downward pressure on prices.
When it comes to demand, what assumptions are you making about demand from China? Because that's key.
Actually, I think demand from China is going to stabilize. Our own outlook is one more for stability with modest upside risks to our growth outlook, maybe from 4.2 to 4.3%. We anticipate some stimulus in that as well. We also anticipate a reasonable outcome to the US-China trade deal. So there are a number of assumptions baked into that price. But overall, I think the outlook now for China growth is one of stability rather than that downward spiral that we saw in the maybe in the first half of this year. I think the building blocks for growth are looking a little more constructive. And as I say, if we anticipate this fiscal and monetary stimulus as well, it adds greater credibility to that outlook.
We know that hedge funds have been shedding their exposure to energy stocks, at the fastest pace in about 10 years. What opportunities, what risks do you see, and what tweaks might you have made in your portfolio?
Well, I mean, we see energy in many respects synonymous or aligned with closely monetary policy. It is a major component, as we all know, alongside food, of course. And if we see lower energy prices, we see lower interest rates, and that's clearly supportive for the fixed income complex. And in our allocations, as you asked, in particular, investment-grade credit, where I think the risk-return sweet spot lies. So those energy prices, I mean, apart from energy-producing nations, but those lower energy prices, I think, ultimately encourage monetary easing amongst the major central banks. And, for us, that leads and underscores the overweight in IG.
And, of course, you're expecting the Fed to do 3 cuts through the end of the year. Why is that? Some say it might not even cut in 2025.
Well, we have a slightly more cautious view on the US labour market. It's our view that it's perhaps not as robust as maybe a consensus in the market might hold. Our view is that actually unemployment is likely to tick a little higher, perhaps not reflected in the jobs numbers we saw last week, but we think there's a little more fragility in that space, and as such our view is the Fed will look through any potential risks in inflation and focus more on the labour market. And for that reason, we think 2 or 3 cuts is more than likely over the course of this year.
What's the risk to that projection? What data in particular will you be looking out for?
Well, I mean, the risk is that the Fed decide not to look through potentially elevated or sticky inflation expectations and keep rates higher for longer. I think the backdrop to energy prices, oil in particular, militates against that. Our view is, and indeed the latest nowcasting I've seen from various Fed shops around the United States suggests that actually CPI forecasts are ticking lower, materially lower in some instances. So I think the case for lower interest rates is pretty strong. Perhaps the labour market repairs substantially. Perhaps the slowdown that we anticipate doesn't materialise. I can't actually see that happening. But it would be that confluence of risks that I guess would encourage us to revisit the data and have another look at the macro outlook.
John, great having you with us. Lombard Odier Asia CIO John Woods there. Still to come, President Trump threatening fresh tariffs on any nations aligning themselves with the BRICS countries. We'll have more details on that group's meeting in Brazil. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. The Trump administration is said to be planning to restrict shipments of AI chips from the likes of NVIDIA to Malaysia and Thailand. It's part of efforts to crack down on suspected semiconductor smuggling into China and would mark the first formal step to rewrite Biden-era restrictions. Avril Hong is here. And Avril, how are investors reacting?
Yeah, I mean, we're seeing a lot of pressure on some of these shares of Southeast Asian companies that are either related to data center operations or tech-related names in the region. The Malaysian, the Thai benchmarks are underperforming. And we also have in Malaysia, the likes of YTL Power, which has a tie-up with NVIDIA over data centers, is the biggest decliner, though it's pairing the declines of about 7.5% from earlier on in the session. To be clear, Malaysia and Thai governments have not responded, and NVIDIA had previously said there's no evidence of chip smuggling, but for some of these companies that have already seen their steepest declines since Liberation Day and had just about been recovering in May amid the US-China détente, this is proving to be a fresh headwind. Now flip the board and take a look at what some of the analysts have had to say about this. We had the likes of Jeffries highlighting that if the Bloomberg report becomes reality, that some of these US companies with operations in Malaysia and Thailand, they could find it really difficult, almost impossible to access advanced AI chips. The likes of Maybank Securities say that they expect minimal impact on chip names, but there could be a sentiment hit when it comes to some of these AI server-related companies. Now, flip the board, because as the sources have been telling Bloomberg that some of these draft plans will not comprehensively replace the Biden-era framework that, as you know, had been a sort of AI diffusion approach that split the axis into 3 tiers. But overall, it does underscore what this debate has been in Washington for years, right, about whether some of the access to these chips, the rest of the world, the US, wants them to be able to access US chips and use US infrastructure, but once it leaves the US, there's no guarantee that this will not somehow make its way to China. Haas.
Avril, thank you so much for that. We have some breaking news here. We have Nissan saying that it will sell 150 billion yen of convertible bonds. Of course, some are saying that the offering gives investors the option to trade debt for equity, comes as the automaker accelerates its electric vehicle push and shore up its capital structure. Analysts also saying that the deal reflects growing confidence in the company's long-term outlook, but it could also lead to share dilution if converted. Again, Nissan to sell 150 billion yen of convertible bonds. Now, President Trump says any country aligning with the BRICS nations will face an additional 10% tariff. His threat comes as the group's leaders gather in Brazil. For more on this, let's bring in our government reporter, Sudi Ranjan Sen. Sudi, what are we hearing from the BRICS nations on the tariffs that Trump is suggesting?
Well, to begin with, I mean, there is a reference to tariffs tariffs, unilateral tariffs that is upending global trade. That finds mention in the BRICS leaders' declaration. It doesn't, of course, mention United States, but it just says that tariffs are unilaterally imposed tariffs are creating problems, headwinds for developing nations in the global south. That is one mention that is there. But having said that, the proposal, President Trump's proposal to introduce or levy more tariffs on BRICS countries or anybody aligning with the BRICS countries and their policies would be of great concern to everybody in the BRICS grouping, particularly because United States is a preeminent economy and countries like India, China, they have a substantial trading relationship with BRICS. And already these countries at one end are trying to negotiate a trade deal. So more tariffs, on the basis of their membership to BRICS and BRICS announcements is bad news or fresh trouble for all these countries.
Sudi, how concerning would Trump's move be for BRICS countries?
It would be very, very concerning because if you look at countries like, say, India, if you look at a country like, say, UAE or Indonesia, all of them have very strong trading relationship. It is a different matter that all these countries have, in the BRICS, been talking about more trade in local currency. In fact, this issue also finds mention in the BRICS leaders' declaration released some time ago from Brazil. And we've seen President Trump earlier making it very clear that there cannot be any move to move away from the dollar. BRICS countries like India per se have been very, very careful and they've been treading the line, very carefully. It's like walking on eggshells for countries like India and so many others. And, they've gone to great lengths to clarify that trading in local currency does not mean moving away from the dollar. But it's an argument that the United States may not quite accept. And that is where the trouble or the problem lies.
Sudhi, thank you so much for that. Our government reporter, Sudhi Ranjan Sen, coming to us from New Delhi. Let's get insights from Nirmalya Kumar, professor at the Indian School of Business. Nirmalya, good to have you with us. What do you make of this threat from Trump?
The problem is, that the threat is perhaps real to some extent, but it's very hard between the fog that is created by the Trump digital and verbal exhaust to find out what is the truth and what is going to happen. Because remember, he had said that he's going to put in tariffs on day one, then it became April Liberation Day, then it became July 9th, and now that July 9th is approaching, it seems to have been pushed yesterday to August 1st. So, one has to wait and watch to see what is the actual tariffs being put in versus the verbal bombast that comes from Trump. And if you notice that he said that there would be 160 deals done by April 9th, and only 2, as far as we know, Vietnam and Britain, have been done. And even in those 2 deals, the details are very sketchy as to what are the tariffs, what is exempt, what is going to be tariffed. And this transshipment thing with Vietnam is especially problematic because we don't know what defines a transshipment. Every product nowadays uses inputs from various countries. So if you say inputs from various countries is transshipment, then every product is transshipped.
It is challenging to keep up with the headlines and also the tariffs that he's wanting to implement. I'm just wondering, is there a sense that President Trump is clear on his tariff strategy? Do you think he has a tariff strategy?
One thing about Mr. Trump, we can say for sure, President Trump, is he has no strategy. I mean, let me just put it this way. As a management professor, all I can say is if you took all your businesses bankrupt, there must be some lack of strategy somewhere. And I think that you can see why his businesses did so poorly, because he responds off the cuff. He doesn't do the preparation required for any serious strategic outlook. And he doesn't come from an underlying framework within which his actions make sense. So it's very hard to make sense of Trump by saying there is a strategy behind it. It's relatively ad hoc. And the problem with this is it creates a lot of uncertainty for companies. Companies cannot invest if they feel there is deep uncertainty about the future economic environment. And what Trump is doing, he's creating a lot of uncertainty, not only for companies, but also for countries. There's no clear strategy that we can ascertain from his words and his tweets. And so as a result of this, he's frozen the economy. Now, there's 2 ways to deal with this. One is to take everything he says seriously, and the other is to ignore it. And what the markets are clearly showing since April is that they're ignoring the entire Trump tariff story, and they've gone on to record highs because they feel that this is just a paper tiger. On the other hand, there's no doubt that some tariffs are coming, and they're going to be real.
Additional tariffs are being imposed under the Trump administration on the basis that the moves are anti-American. The BRICS nations, a case in point. I'm just wondering, how might this play out as countries around the world actually look for alternative groupings, alternative trading partners, because these moves can be seen as anti-American in Trump's eyes?
Yes, so what Trump sees as anti-American is survival for other countries. Other countries have realized that, given that we can't now count on America as a reliable ally, what do we need to do? We need to find strength in numbers, even though, if you take several small countries together, it doesn't make the same impact as China or America. But you're seeing that Europe is moving closer to Australia and Japan, who they think are more like-minded than them, and Canada. You see, so this is going to happen and to some extent, if he comes down very hard on the Southeast Asian countries, I think what he's going to find is that China is the beneficiary, not the loser, with respect to those countries.
Because
it is going to
take them into
the... Yeah, sorry.
Is there a sense that eventually the U.S. will be isolated?
I think U.S. is too big, too interconnected to the global economy to be isolated. We still rely on the dollar to a large extent for global trade. So let me just say, it won't be isolated, but people will say, okay, we need to just survive the Trump era. Because the good thing is Trump is not a dictator a la, let's say, Russia or China. So we know that there is an end date to the Trump administration, which is 3.5 years from now. So what people are going to say is, can we come up with some policies and strategies to kind of survive this 3.5 years and then hope that the next administration will bring America back to the path it always was on and normality. And so as a result of this, I think, the countries are playing a double-sworded game in some ways. In one way, they kiss up to Trump to kind of keep him happy. On the other hand, they're looking for alternatives as a way to mute the impact of tariffs on their economies and their companies.
If you maintain that the U.S. is too big, then perhaps Scott Bessent is right. Forget about de-dollarization. That's not going to happen.
I mean, if you look at, can we be honest? Every Indian, Chinese, and Russian billionaire keeps their money in dollars. Okay, so de-dollarization is going to take a very long stride. Yes, people want to keep their money in some other alternative currency, and the euro has clearly benefited from that. And the yen will benefit also to some extent, though the yen hasn't benefited as much. But, the fact of the matter remains that we cannot get away from the dollar in the short run.
Isn't it true, Nirmalia, that in the end, U.S. consumers, U.S. companies will suffer as well? We know that Trump is intending to put, for instance, export controls when it comes to those chip exports from Malaysia, from Thailand. In the end, U.S. companies will be hit as well.
So there is no doubt that all the academic literature says tariffs should hurt the country imposing the tariffs because it makes things costlier for their consumers and it should slow down the economy. Unfortunately or fortunately, up to now, in the 3 months since that the tariffs were announced in April, we have not seen that impact on America, right? We have not seen rising inflation to any extent, which is alarming. We have not seen a slowdown in employment. We have not seen a slowdown in GDP growth. So maybe the markets, as well as the economy, is not really responding as it should respond to the Trump bombast.
You talked earlier about how China will be the beneficiary. How might this play out?
So China could be the beneficiary if the Southeast Asian countries, which are much greater interconnection with China, decide that, the U.S. we can't rely on for exports. And in the end, the market says very clear, U.S. is the largest market in the world. China is the second largest market in the world, and the European Union is the third largest in the world. So if I'm going to lose my largest market, then I have to move to increasing exports to the second and the third largest bloc, which is China and European Union. Now, the European Union is, of course, clearly worried about this. They are expecting a flood of Chinese imports coming, which has already started. So they are now thinking we are caught between a rock and a hard place. On one hand, U.S. has become an unreliable ally. On the other hand, we do worry about subsidized Chinese imports coming into Europe and wiping out our industry.
Nirmalia, how about India? It was meant to be one of the first deals to be concluded for the Trump administration, but here we are with nothing, still nothing so far.
I suspect the Indian deal will take the longest to complete because the Indians, the biggest thing that America would want is access to the farm agricultural market because America is a very large agricultural country and export country, and India is a large importer of agricultural imports. So that's how they work. Unfortunately, the farmers would be hurt by this. The consumers would win, but the farmers would be hurt. And to tell you the truth, what Trump is doing on tariffs against India, I'm not completely against, because India has always had one of the highest tariffs in the G20 nations. And so those tariffs need to come down so that the Indian consumers would benefit. Unfortunately, the Indian farmers are a very important lobby and political voting bloc for the BJP party, which is the Modi's party currently. So I think that they are going to have a very difficult time conceding on agricultural imports, which is why I suspect that deal is going to take a lot longer than people think.
In the end, though, is it conceivable that we'll see a win-win U.S.-India trade deal?
I hope so. I would not put my large dollar on it.
How might that look like?
So it would look like that some part of agricultural imports is excluded from the deal, but they do a deal on the rest, like buying more oil, reducing the tariffs on cars, which are very big and very important for Trump. So you have to always figure out what does Trump really care about. And I think he cares about automotive and oil very much. Maybe the agricultural is perhaps not as important and he's willing to concede on that. Having said that, the negotiators that Trump has often are not empowered to make the deal even because they still have to go back to the boss for a yes. So it is very hard. And in general, a trade deal takes minimum 2 years to do. And he was trying to do everything in 90 days, and that is just not possible. So I think that there will be a deal in the end, but I think it will be much less transformational than people expect it to be.
Nirmala, just one final question. What is the biggest worry for you as you look at the trade negotiations happening right now, the uncertainty of it all?
The uncertainty is the biggest thing. And the biggest fear is that at some stage, Trump doesn't care about the impact, but he has a worldview which says that tariffs are very good and imposes arbitrarily large tariffs on the global economy, which makes the entire global economy slow down. Because America can still impact the global economy. There is no other country in the world that can impact global economy as much as America. So our biggest fear is that these off-the-cuff, knee-jerk tariffs, without having thought through the entire strategy, lead to a slowdown in the global economy.
Nirmala, thank you so much for those insights. It's been fantastic having you on the show. Nirmala Kumar from the Indian School of Business. Now, still to come, today's Bloomberg Big Take is a closer look at the Indian regulator's surprise move to restrict trading on Jane Street. We'll have the latest on that expanding investigation next. Keep it here with us. This is Bloomberg. India's just kicked off its trading day. The first 5 minutes, let's take a look at how the initial numbers are looking at this point in time. We have the Sensex as well as the other benchmarks currently down in negative territory. The Sensex down about 0.1%. Of course, keeping an eye on those trade negotiations between the U.S. and India, and India's regulator planning to expand its investigation into alleged manipulative trades by Jane Street Group after announcing a surprise ban last week on the U.S. firm. The Securities and Exchange Board says the next phase will include other major stock indexes beyond the original focus on options trading. For the latest, let's bring in our Asia equities reporter Chiranjeevi Chakraborty in Mumbai. CJ, talk to us about what is expected from here.
Well, what is expected from here is more investigation. First of all, SEBI, after putting out this order, has given Jane Street about 21 days to respond to its findings and allegations. Now, once the Jane Street's response is in, the regulator will form further opinion. There is still a lot more investigation to be done. We reported on Friday, talking to officials at the regulator, that they'll be now looking into Jane Street's trades in other stock indexes, major stock indexes in India, which includes, the benchmarks such as the Nifty 50 as well as the BSE Sensex. So the road from here on is quite long for this investigation.
SEBI's action is seen as a watershed moment for India, and it wants to take action against big global players seen as gaming the system, gaming the market. Might it include other players as well, apart from Jane Street?
Well, at this point of time, we don't have any such indication. But what is quite clear from people we are speaking to is that the regulator is trying to send a message here to everybody involved, not just global high-frequency trading firms and hedge funds, but even local players that, you have to play by the rules. The market is open to you. You're most welcome to be here. But you have to play by the rules. You cannot do trades or undertake activities that can be perceived as illegal or manipulative in nature, because at the end of the day, SEBI's mandate is to protect the retail investor, and we know that in India, retail investors have lost upwards of $21 billion trading options, and so 9 out of 10 retail investors in India, retail traders in India trading in options have been making losses. And the regulator has been quite concerned about that and has been on a mission to basically nip out the speculative frenzy that had gripped the Indian derivative space over the past 5 to 6 years.
So retail investors have hurt, but foreign funds, prop traders, they made a lot of money. We know that they made in excess of $7 billion in a period of 12 months. So it is a very lucrative options market. I'm just wondering, is it, the beginning of the end for the Indian options market?
Well, according to some, it might be. Maybe the heydays are gone. But, some are also telling us that probably this is a good step for the overall development of the market, because you had that initial boom phase with unfettered growth and unfettered profits running into billions. But of course, now with this regulatory action, we do expect some sort of chilling effect, on the overall HFT industry. But ultimately, those who are quite optimistic and bullish about Indian market prospects, they say that this might actually help those who are here in India and those who are outside looking in to actually, make their systems, make their trading practices much more coherent and much more aligned with the regulatory requirements here in India.
But you got to wonder, CJ, how foreign funds will now look at the opportunities in India, because the likes of Jane Street, Citadels, they've been boosting their operations. They've been investing into their operations in India. Might they pull back? Might they wait and see? What are the indications so far?
Yeah, I think the latter. I think wait and see is probably the approach. Let's not forget, besides the Jane Street order, there has been a lot of regulatory changes that have come into effect in the Indian derivative space. Since last year, we had several curbs imposed on retail traders, on minimum investment levels, a lot of products as well. Plus, we are currently ongoing a new way of calculating open interest in the market, which is probably one of the first all across the world. So there is a lot of change to contend with here. Plus, now on top of that, we have had this very surprising and very shocking order against Jane Street alleging market manipulation. So that will, of course, make global managements all across the world sit back a little bit, maybe reconsider their plans, maybe consider the trading teams and the strategies that they plan to deploy in India. So it will take some time to wrinkle out a lot of these issues, and let's see how it pans out in the coming 12 to 24 months.
How about SEBI? What steps might SEBI take? Because we know some of these companies, these funds, actually have, data centers, presence in data centers which are actually owned by the exchange.
Yeah. I mean, I think SEBI's focus clearly still remains on making sure that retail investors or small investors don't continue to lose money that they're losing. Of course, they can't do anything about investors who are trading by their own volition, but they want to make sure that they are ring-fenced, or at least the market that they're participating is free and fair. And I think that is what the next step would be. Any regulatory changes coming up will definitely address that issue.
CJ, we have to leave it there. Great story, great insights. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.